Hi, folks. Welcome to our second quarter market review and outlook. We're going to give everybody just a minute or two to get logged in, and then we'll get started. But as we're doing that, I want to ask everybody to locate the Q&A button on the bottom of your screen. There should be a little question mark and then the letters Q&A. And I'd love to just hear one word, two, three at the most, how you're feeling today. Are you feeling confident in our economic outlook? A little meh, as my teenagers would say, or really nervous? So, all right, I can already see a few coming in. So don't hold back. Clearly nobody is. So we'll give it another minute or two, and then we'll get started once everybody has had a chance to get logged in. Okay, so super interesting. So a lot of anxious, nervous, whiplash, hanging in. William feels great. Congratulations. You're moving against the trend there. Somebody else feels confident after meeting with my advisor. So glad to hear that. And that's exactly why you should talk with your advisor. Let's see, feeling confident, haha, worried. Okay, this is super helpful. So let me also ask you a different question, a little bit more specific here. If you're worried, what is it you're most worried about? Higher prices, not being able to get goods that you want, recession, market down, not being able to retire. These are just some things that I've heard from other folks, but would love to hear some more from you guys about what it is that you're most nervous about. Not worried at all. Go, Michael. That's awesome. All right, not trusting the government, recession, uncertainty, just retired, rising costs, inflation. Will things rebound in time for me to retire? Market not coming back, volatility. Okay, super helpful. Not being able to get supplies. Excellent. Okay, super helpful. It's always really good for me to understand what it is that people are most worried about. We're going to tackle a lot of these things. But if there is something that comes up and you're curious about, please use this Q&A here to be able to type in additional questions. We've gotten a lot of questions from you guys in advance, and so hopefully we'll touch on some of them as we go through sort of our regular slides, and then we'll spend some time towards the end and I'll go back to those questions and see if there are some that we haven't answered, and then any new ones that come in. So, as you can probably gather from hearing these answers, we've had, a fair amount of volatility and uncertainty heading into this year. So it's no surprise that everybody's feeling a little bit anxious about it. John, actually, I should introduce myself. So I'm Kara Murphy. I'm Chief Investment Officer here at Kestra. I work closely with financial advisors to sort of stay abreast of what's happening in the market. And understand, how to make good portfolio decisions. And there are times when that's harder to do, which is right now, in times of market volatility. So we'll share with you a little bit about what we're seeing right now, and then how we're handling it from a portfolio perspective. And at the wheel managing the slides is John Choquette, who's an analyst on the Kim team. So thank you, John. He does a lot of the research that ends up in these presentations. So John, if you could take us to the table of contents, and I'll just run through, and of course, the disclosure slide. We'll quickly set the stage for remind everybody what we were talking about at the beginning of the year, then look at how the market has reacted in the face of these tariffs. And then importantly, look at the economic environment, because how well positioned an economy is in advance of an economic shock, and I think that's what tariffs are, is really important. So how well can the economy withstand something uncertain like this? Then we'll talk a little bit about tariff specifics, and I see, a number of questions on specifically on how tariffs work here, and then investing in an uncertain environment. So how do we think about building portfolios? What should you guys be looking forward to? And so we'll share some of those insights. So first, in terms of setting the stage, if we sort of like teleport back to the beginning of the year, there were two sort of categories of risk that we were most focused on. One was related to the market itself. So you've probably heard about the Magnificent Seven. usually when I'm talking with individuals and I poll a crowd on who's in the Magnificent Seven, people can come up with them. They're pretty household names: Google, Apple, Microsoft, Tesla. These are names that have been in the headlines a lot. Some of the largest companies in the U.S., which have also had some of the best performance over the last 2 years in the market. NVIDIA, right? That's been the big one that's taken a lot of headlines. So what's happened is that 23, 24, those names did extraordinarily well, really helped the overall market. But by the end of 2024, heading into this year, those Magnificent Seven names were quite expensive. And because they have done so well, they made up an inordinate amount of market cap of the S&P 500. So that meant that the S&P 500, which is normally a very diversified index, 500 different names, it was very, very heavily weighted to just those seven names. So to us, that represents a risk. And you'll see on the lower left there, so this is a typical valuation measure. This is going to give us an indication of how expensive the market is going to be. So if you broaden out just from the Magnificent Seven into the largest 10 names in the S&P 500, those names at the beginning of the year were trading at about 30 times forward earnings, or how much we thought those companies could earn over the next 12 months. When you compare that with everything else in the S&P 500, those remaining stocks were only priced at 18 times, right? So again, that valuation, or how expensive those names were relative to the rest of the market, was really extended. And the S&P 500 overall was pretty expensive compared to its historical average. All right, so that's one risk. The other risk that we highlighted was policy uncertainty. And whether you're a Trump supporter or you hate him or you're somewhere in the middle, this new administration came in with this idea of introducing a significant amount of change, and in a lot of different areas. And we've seen that in spades since the inauguration. But so this idea of policy uncertainty in our mind was very high even before the administration took office. So this chart on the lower right measures policy uncertainty around the globe. So this is not just the US, this is reflecting a global view. And that latest data point is actually from January. So remember, this is pre-inauguration. So even in advance of this, the world was sort of bracing for a huge change in global policy. If you look at the US version of this, which is updated more frequently, you'll see a huge spike. So policy uncertainty well above what we experienced during COVID. So if you feel uncertain, this is being reflected in some quantitative measures as well. And so there's been a lot of change that's been introduced in different areas of the government, but the one that's been the most sort of impactful for the market has been tariffs. And I like to share this historical perspective as a reminder of like why this is such a big change. So this is simply looking at the amount of tariffs the federal government has collected over the last 100+ years compared to all imports. And you can see back in like 2018 or so, before the Trump tariffs were announced in his first administration, the average tariff rate was running below 2%. And if you go back, that rate had been coming down for about 100 years. And then all of a sudden today, and again, this is sort of a guess, but we think it's running about 28% on average relative to all imports. So this is just a massive change after 100 years of bringing tariffs down. Now all of a sudden we have this huge step up. This is why the market is grappling with it, because it represents not just a different direction in terms of where tariffs are going, but the magnitude is really large. So this is what we're trying to digest. So let's take a quick look at what's been happening in the markets. Because I think it's important to realize that if you just turn on the evening news, it's going to feel like everything is being sold. But when we look under the hood a little bit, the market is actually being quite discerning about what is being sold and what is not. Not everything is going down at the same time. So remember, we talked about that Magnificent Seven, right? Seven of the largest names, heavily technology focused, quite expensive. Those names are down almost 20% so far this year. And these numbers are as of yesterday's close. So they're rallying today, so they look better today, but who knows about tomorrow. But those are those names that have done the best over the last 2 years and were the most expensive have performed the worst so far this year. The US stock market overall, so S&P 500, is down about 10%. That's well off the lows that we saw a couple of weeks ago. But then interesting, look at emerging markets and developed ex-US. So developed ex-US are things mostly Europe and Japan. Those things are actually up. So up 7% year to date, and have been like a real bright spot in the equity markets around the world. And then I want to draw your attention to US bond aggregate. So this is a wide representation of the fixed income market. It's pretty representative of what a lot of people own in the fixed income portion of their portfolios. That is up about 1.5% so far this year. So again, like these are things that, most investors have exposure to, and these are going to help buoy any portfolio that you might have. So let's look within the S&P 500 at different sectors. So here too, you can see some very different performance. Over on the right, you'll see information technology, consumer discretionary. This is where most of the Mag 7 live. And so you'll see those are the areas that have underperformed the most. Now look all the way over on the left, you'll see consumer staples. Those are things that people generally have to buy regardless of the economic environment. Think things like toothpaste and shampoo, those things that you're probably not going to scrimp on even in a tight recessionary type environment. Those names are actually up so far this year. Utilities, similar, how you get your electricity, how water is delivered. Those are things, again, that, you might be more conscious of turning off the lights at the end of the day if you're, worried about your job, but you're not going to turn off your electricity altogether. So those types of names are also up. So again, I think it's helpful to see that this is not everything being sold altogether. The silver lining too of some of this downside in stocks is valuation. So I mentioned earlier, we were concerned at the beginning of the year about valuations being fairly high relative to history. So this is looking at the price of the S&P 500 compared to what collectively all the companies in the S&P 500 compared to what we think they can earn over the next 12 months. And this goes back to 2000. So it's a pretty good 25-year history. You'll see that peak there is at the beginning of the year, and that's among the highest levels of valuation that we've seen over 25 years. That doesn't tell us that the market's going to turn down, but what it does tell us is that the market is vulnerable to bad news. And then you marry that with policy uncertainty and tariffs, that's where we're seeing most of the challenge in the market today. The good news is that we've come down from like about 21-ish times to about 19 times here. We're still not at average, which would be 16.5 times, but that valuation has come down, making the market less vulnerable to bad news than what it was at the beginning of the year. All right, so let's take a quick look at the bond market. If you've been following this tariff stuff closely, which I hope you haven't, because that can cause a lot of anxiety. But if you have, then you've probably heard a fair amount about the bond market, specifically Treasury market. So this is the 10-year Treasury yield. This is a sort of market bellwether that we look at very carefully. And you can see kind of where it's gone over the last 12 months. Towards the end of 2024, you saw long-term yields going up. And then so far this year, they've largely come down. This chart on the left is masking a lot of volatility that happened intraday. So that's the chart on the right. This is showing you a screen of what happens every minute of every trading day. So where do those bond prices go? On the left are yields, on the right are bond prices. Yields go up, bond prices go down, and vice versa. It's confusing, but just trust me, when you look at that chart on the right, what you see are big swings up and down. So that note where we have long-term yields spiked during tariff fears, when yields go up, bond prices come down. So bond prices came down significantly after tariffs were first announced. And then you see on April 9th, it was Trump in the middle of the day announced a pause. And what you see from there afterwards are bond prices sort of bouncing around in a much narrower range. So again, it's not to say that they're not changing, but that huge downdraft that you saw during that tariff period has now mitigated, right? So some of that volatility has been pulled out of Treasury markets. So let's take another look kind of underneath the hood at what's been working and not working. So these are looking at different factors. So, other types of factors can be minimum volatility, quality, profitability, growth and value are two kind of very typical factors that you'll hear talk about among investors. Growth companies are those that are generally growing their earnings faster. Value companies are those that have lower valuations, right? And often a company will fit more into one bucket versus the other. Remember that Mag 7? Tesla, Microsoft, Apple, Google, Meta. Those are all growth names. They're growing their earnings very fast. Often those types of companies, we're going to be less worried about what we're spending for them because we just want them to grow, grow, grow. Those names in 2024 did really, really well. Value did not do so well. Stocks that were, maybe a little bit more mature, slower earnings, but cheap valuations, the market sort of left behind last year. This year, it's been the complete opposite. Growth has underperformed, value has outperformed. So again, just to highlight the fact that those stocks that have been performing well have changed very drastically this year relative to last. Okay, so let's take a closer look at from Mag 7 to Lag 7. So just a little annotated look at some of what's happened along the way. So again, there has been a lot of focus on tariffs, but remember in January, DeepSeek came out. So this was the first really important competitor to like a ChatGPT. Uses much less computing power, would suggest that there could be an alternative that doesn't need these special NVIDIA chips, which sort of calls into question, the US advantage in AI. So this too, I think, has had an impact on some of these more technology-oriented names. But that gold line there is showing you what's happened to the S&P 500. So a very diversified basket of large stocks. The green line is the Russell 2000, so smaller stocks. And then you can see the Magnificent Seven. It's essentially the reverse of what we've seen in previous years. With that, let's also take a look at international versus domestic, because I think this is really important. And I saw a number of questions from you guys, and like, what can I do to sort of inoculate my portfolio to some of this volatility? Now, you can't get rid of volatility altogether. That's part of what you get by being an investor. But here's one way that you can make sure that you have diversification in your portfolio. So the dark line is international, starting at the beginning of 2025. So this is MSCI World ex USA. So it's looking at all the other markets around the world and taking out the US. US is about I think 2/3 of the overall MSCI. And what you've seen there is that so far this year, those markets have stayed in positive territory. Now, it's interesting because tariffs are global by nature, right? They impact global trade. But that gold line there is domestic returns. So what's happening in the US, you can see firmly in the negative. What this is telling us is that tariffs are actually more of a concern for US markets than they are for non-US markets. And what that means is that as investors, we have the ability to diversify out of just the US and be able to identify other markets that might be a little bit more immune to some of this policy volatility. Two other asset classes I want to touch on quickly. One is oil, which has been very interesting to watch. So that's that dark line. You can see where oil peaked in 2022. I don't know if you remember trying to fill your gas tank then. I was like, dang, my car takes a lot of gas. It was really expensive. But then look all the way down to the right. And what you'll see there is that oil has been dropping essentially for 2 years and actually currently is trading, I think, below 60 bucks today. So less than half of where it was in 2022. So as we think about consumers sort of potentially grappling with higher prices, these lower oil prices are actually a very helpful offset because you're spending less money when you go to the gas tank, but you might be spending more money when you go buy a bunch of new t-shirts, right? So these are offsets. Again, it's not perfect, but it is one area where we might get some relief. That gold line is gold. And you can see where over the last like 2 years, gold has just gone on this significant move up. And we get a lot of questions on this, and we'll have another look at this later. But this is a lot of investors that are sort of rushing to an asset to protect themselves from volatility elsewhere. And we'll talk about why we're actually not huge fans of gold, something to keep in mind. But I realize that people do sort of move into that asset class when they need to sleep easier at night. All right, so with that, let's talk about the economic environment. And as I said earlier, how well positioned is the economy to handle what is a shock? This is our dashboard. We update this regularly. It's 5 different areas of the market that we focus on most closely. And the team will sort of spend some time talking about where we think these should be rated. And what I'll say is just look at those indicators. They're kind of all down the center of that range. That's actually a pretty nice place to be. There's nothing that's running too hot. There's nothing that's running too cold. And that's not a bad place to be. And we'll dig into each of these. But you're always going to have different areas of the economy that are stronger than others. But this actually provides a fairly good base to go into what is a more challenging period. So let's take a look first at consumer sentiment. Because as we're going to go through this data, there's a theme of soft data versus hard data. Hard data are like actual spending numbers, how much are company earnings, how many jobs are being created, and economists tend to focus a lot on that hard data because it's real. But then there's what we call soft data, and that's more sentiment. What are people saying? And that can be an interesting prelude to then the hard data. Right now, as you can imagine, this tariff stuff has been happening so quickly. We haven't had much of a chance yet to see it in the hard data because that typically comes a little bit later. But where we have started to see it already is in some of the survey data or the soft data. So this in particular is looking at a consumer survey, and there's a whole series of questions that people get asked, but this is the kind of overlying index. And that red line there is showing you the average level of consumer sentiment during recessions. And what you'll see there, if you look all the way over on the right, you'll see that consumers are telling us that they're more pessimistic today than they typically are during a recession. That's pretty negative. Now you'll notice in 2022, as gas was at that peak and other people were, surprised at how much it costs to fill their gas tanks, sentiment was also at a low. So we've had other periods where sentiment has been very low, where we haven't had a recession. But this is essentially consumers telling us that they feel like we're already close to or in a recession. And looking at a lot of your sort of answers here, it feels like a lot of you are feeling that way too. But let me ask you a question. And if you could pull up that Q&A button again, I want to know, I'm going to guess that many of you at least align with this sort of more pessimistic view of the economy. Has this impacted what you're spending? So have you changed what you're spending based on how you feel about the economy? So if you don't mind, uh, no, not yet. Yes, 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 absolutely. No, somewhat spending less. No, no, yes, yes. Okay, so again, this is not terribly scientific, but just sort of scanning through these, and thank you for all of these, super interesting. This feels a little bit more half-half. About half of you are saying, yes, I have slowed my spending. Others are saying no. So John, if you will, let's go to the next slide and I'll show you what the hard data looks like. So this is what we call real retail sales. So this is looking at what are people spending in stores, but then we take out inflation, right? Because inflation can kind of monkey with things. And if you look back to 2022, so remember, that was a period with high oil prices, high inflation, low consumer sentiment. Real retail sales, so like how many bananas or how many t-shirts were people buying, was in negative territory. From about 2023 on, it's been improving. And in fact, just what was that, last week, we got numbers for the previous month showing that retail sales ex autos, we take out autos because they're very volatile. They can sort of move the numbers around, was actually in positive territory, the strongest number that we'd seen since 2022. So we're seeing this interesting dichotomy between people saying they don't feel good and people still showing up at the store and spending. Now, some of this might be pull forward spending. So for instance, my son just got his driver's license. We knew we were going to have to be buying a car in the not too distant future. So we rushed out to go get a car before tariffs came in. I also bought tequila because I've developed a taste for tequila since moving to Texas and I didn't want to have to pay tariffs on it. So, so I bought more of those two things than I normally would have. So I pulled forward some of my spending. Right. So there might be some of it. So we'll have to watch this hard data over the next couple of months to see, is there going to be a decline in real retail spending? But so far, it seems like consumers are feeling confident enough that they're willing to go to the store. Oh, bourbon is better. Okay, we'll have to we'll have to do a bourbon versus tequila face off. That sounds like fun. And Franny, I see you're with me on the tequila. Thank you. So this is looking at the labor market. And if you remember in the economic dashboard, we rated the labor market as actually one of the strongest areas of the economy. And in fact, if you think back to the beginning of last year, the labor market was one of the last areas of the market or the economy the Fed was looking at to slow. In many ways, the Fed was uncomfortable with how strong the labor market was, because when it's hard for employers to hire employees, they need to pay more for those employees. That pushes up wages and that pushes up inflation, right? So that labor market tends to be a feeder for where inflation goes, and the labor market just wasn't slowing like the Fed was comfortable with. And in fact, so if you look here, you can see in general a little bit of a deceleration in number of new jobs. So non-farm payrolls, how many new jobs are being created month to month. Then look at that March number. This is even as federal government employees were being laid off. We still had this very, very strong number in March. So this is telling us employers are still hiring. So, when we ask employers or CEOs how they're feeling, they're saying not great, but then they're still going out and they're hiring people. So again, we have this difference between soft data and hard data. One other aspect of this that I think is important to sort of think about in understanding how well positioned the economy is thinking about leverage. So how much debt do companies and individuals have that puts them at risk of a downturn? So think about the global financial crisis. So if you will, like start with that chart on the right that looks at household debt as a percent of net worth. So this is taking all households, rolling them up together. How much debt do you have and how much are you worth? Now, again, there are going to be a lot of differences kind of within this, but in an aggregate basis across the US economy, heading into the global financial crisis, we had this enormous rise in debt relative to net worth. That's all that subprime mortgage debt that was being put on consumers' balance sheets. Then when house prices came down, people lost their jobs. There was this massive unwinding that just pulled the whole economy down. And then even as the economy started to stabilize and grow again, it took years for individuals to be able to work off that debt and really slowed the economic recovery. But look at that number today. I mean, we're at among the lowest levels that we've ever seen. Similarly, if you look on the left, this is looking at corporate debt to equity, so all the largest 500 names in the S&P, one of the lowest levels that we've seen in quite some time. So this is telling, and this is like one measure. There are a lot of different ways of looking at this. So don't take this as like the only view. But in general, there's not a ton of debt on corporate or individual balance sheets that can really sort of drag us down in the middle of this tariff kind of challenge. Now, and let's save this for the questions, but the area where there is a lot of leverage that is concerning is the US government. That's an important discussion as well. So let's pin that for a little bit later because I think it's important. So lastly, in terms of thinking about the economy is inflation. So recall, a number of years ago, the Fed set out 2% as their target rate for inflation. That's where they want to get year-on-year price increases to. We've always thought that that's too low a level in this type of an environment. And that's even before we got to tariffs. It just feels like the sort of more normal level for the economy is a little bit higher than that. And that's okay. That's not a bad place to be. But now you throw on tariffs, which is going to raise the level of prices. And we can talk about how that happens over time. But it's going to be even harder for the Fed to get to that target of 2% inflation rate. So, we were just discussing this with the team earlier today, this sort of view of how much the Federal Reserve can cut interest rates. And I just don't think that the Fed has a lot of wiggle room right here to be able to cut interest rates. Number one, lower rates are not a great sort of salve for something for a policy like tariffs. And number two, the risk of inflation sort of getting out of hand is much greater. So right now the market disagrees with me and the market's pricing in 4 cuts this year. I don't think we'll get there, but it is something that we'll have to pay very close attention to. All right, so let's dig into some of these tariff specifics. You know, I think we all probably feel like we know more about tariffs than we ever wanted to know. So I'm not going to go into too much detail here because you're probably getting it from a lot of different news sources. But again, just a reminder of like what a huge change this really is, that suddenly we're looking to bring tariffs back into the policy discussion. A couple of other things I'll just add quickly on this. If you notice that the Trump tariffs, when they were introduced in his first term, they went up in 2018, but they stayed there during the Biden administration. So this was an acceptance by the Democratic Party leadership that tariffs were an okay tool to use in economic policy. So remember, like I know Trump has really sort of established his agenda on much higher tariffs, but you have an agreement on both sides of the aisle that this is something that we should be doing. Um, in addition, we have our trading partners who are now sort of viewing tariffs as a viable policy tool. And so even if, let's say the administration just completely changed their mind tomorrow and said, never mind, we were just kidding, we're not going to talk about tariffs at all, we're going to see other countries start to use that as a more aggressive tool going forward. All of this is to say, this like era of free trade at all costs, I think is over. So again, whatever the tariff number ends up being, it will be higher and will be higher for the foreseeable future. We can live in that type of environment. It doesn't mean that everything's going to fall apart, but we should get used to the fact that we're not going to be able to get access to absolutely any good around the world that we want, and that we're not going to have this disinflationary pressure coming from ever lower cost of goods produced elsewhere within the US. Now, I also get a lot of questions about why tariffs. I don't understand why people are using this at all. So I put this together just as hopefully a helpful kind of view in the different arguments for and against. So I often encourage people to think of free trade and tariffs as two sides of the same coin. And again, for 100 years, most of our policymakers have believed that encouraging trade was a good thing. And with that, generally, you see stronger economic growth, both in the US and in the globe in general. You expand market access. Think about all those goods that you can buy today that you were never able to get just a couple of decades ago. Boosting innovation, competition, right? If you have more people who are trying to make a better widget around the world, in theory, you should end up with a better widget. Lower prices, we talked about that, being able to import low-cost manufactured goods from elsewhere. That's driven down consumer prices for a long time. And then the piece of this that I feel like doesn't get enough discussion is closer political ties. And I have a confession to make. Before I started working on Wall Street, I was an international political and economic risk analyst, and that's what my academic background is in. So I find this aspect very, very interesting. And I think a lot of folks who are just focused on the economy and markets sort of miss this very important wrinkle. Free trade always has had a political component. It was seen as a way of binding together the US economy and politics with our friends and with our adversaries. So think about the European Union. This was a very calculated exercise to knit together a number of European countries that had had devastating wars against each other, make them more economically dependent on each other, and make it less likely for them to attack each other. So that's sort of like a dramatic example, but I don't want that to get lost, that this has been an important part of the equation. So then you reverse those. Why would you use tariffs if you get all this other stuff? So one is to protect domestic industries. Think back to COVID, when all of a sudden we figured out that all of the face masks that we use are actually made outside the US, and we didn't have any. That's a pretty devastating thing to find out exactly when you most need it. So it makes sense that there are certain industries for like strategic reasons or security or health that you want to keep close to home so that you can control it more. generating revenue. So this has been one of the positives that the Trump administration has brought up in terms of tariffs, being able to help lower that fiscal deficit that we have. We can actually bring in dollars. Correcting trade imbalances, right? The US buys from other countries much more than it sells. We want to correct that a little bit. Now, I would argue this is one of the more controversial sort of justifications for tariffs. And so economists, will have very differing views on this. Encouraging strategic industries would be another one. And I mentioned face masks. There's also like steel tends to be seen as something that's very important from a defense and an industry perspective. So a lot of countries will use tariffs to protect those. And then the other piece is political leverage, right? That's the other side of the closer political ties. And if you go back to February, when the first headlines came out about tariffs, all of them were for political reasons. It was the fentanyl trade, it was immigration across our borders. None of it had anything to do with economics. Now, since then, we've certainly seen plenty, but I think it's a good example of where tariffs are being seen as a tool, not just to be used for the economy, but for other goals as well. So food for thought. I have this image that came from the Wall Street Journal, and I just felt like it was very helpful in highlighting how complex our economy has become. So this is looking at one single piston in a US-made truck and where it goes. And you can see it's a little hard to read, but up on top, you'll see number of border crossings, 6. So think about that. It is one single relatively small piece in a large, very complicated machine that goes back and forth across multiple borders. Now imagine that all of a sudden you're tariffed at every one of those. So the cost starts to go up pretty quickly. And then imagine that there's anything else that like slows that trade or makes it more complicated. You're really kind of putting a lot of gum in the works of your ability to create that car. And again, this is not like a value judgment on tariffs, but just highlighting that after 100 years of progressively easier trade, our manufacturing systems have depended on that and need to be rethought if tariffs are going to be the new way of business going forward. And this will take some time for companies to really sort of understand and parse through. Okay, so what actually happens? Oh, so this is a highlight of trade, or they call it here a tariff gap. So this was put together by Capital Group and a helpful look at kind of some of the imbalances that we've been talking about. So you see China now has in fact, today, this is back in March, so the number has gone up significantly. But after the first round of Trump tariffs, we actually had a much higher tariff on China than China did, right? So you'll see a lot of differences between what we tariff other countries' goods and what they tariff on ours. And this has been a big focus of the Trump administration. They've also talked about incorporating the VAT rate in this. So this is a value-added tax that some countries put on different goods. I would argue that really shouldn't be part of the calculation because we're not including sales tax that we would put on consumer goods in the US. But just a little helpful table. So the question is then, like, what happens once tariffs come on? And we have this like little bit of an experiment back in 2018 when Trump first put on his tariffs in his first administration. So those blue bars are percent of total imports between US and China, Europe, and Mexico. And then the orange bars are what that looked like 8 years later after the first round of tariffs had been introduced. What we see is that consumers and businesses shifted their buying from China to Europe and Mexico. If you look in aggregate, the amount of goods that the US imported on those 2 dates, it was the same. It was just the trading partners that we chose changed because we were able to get cheaper goods from other trading partners. Then those goods that were specifically targeted as part of those tariffs, we have evidence now that those prices did indeed go up. So that chart on the right, the dark line is the price of those like handful of items that were heavily targeted by the first round of tariffs. The dotted line is general prices for other types of goods. And what you see there is that other types of goods are actually falling in price, and then the price of these other ones are increasing. And in fact, those prices went up regardless of whether the product was produced abroad or in the US. Meaning that as, let's say, a dryer from China became more expensive to import, American producers of dryers raised their prices to sort of meet that. So this is to say that like a good bit of those tariff costs were passed on to consumers. Now, here's the positive side of it all. Unless you were shopping for a dryer, you probably didn't notice this. The impact was so limited to a handful of goods that it didn't really have an impact on the broad level of prices. And so most consumers just kind of went right on by and didn't notice it. So that's why the level of tariffs and the breadth of tariffs is so important. And here's another thing to think about. So this is a study that came out just recently looking at what can happen if we can find other substitutes. So if you're looking at a sample good, and you'll see the amount of the effective tariff rate from each of these different countries. And then think about, well, I don't have to buy my dryer from China. I can buy it from Mexico, which is subject to much lower tariffs. If there are easy products that can be substituted from other countries, consumers and businesses are going to move their business. And with that, that effective tariff rate goes from 25% all the way down to 15%, simply from that first order substitution. That's why this is so difficult to predict, because we can tell you what the tariff rate is today based on goods that were bought, yesterday. But if those prices go up significantly, people are going to change their behavior. And over time, that impact from the tariffs is going to decline. There are certain things that we can't substitute, and those are much harder, and those prices will be sustained. So let me give you one other example. And if I could ask you to pull up your Q&A window again, this is very important. How do you take your coffee? Because I am a coffee addict, and I have to have 2 cups a day, and I take it with cream. And if I don't have my cream, I'm really grumpy. And my husband knows to not talk to me until I've had at least 1 cup of coffee. So I see a lot of black. I don't drink coffee. Michael, I feel bad for you. I feel bad for people who don't drink coffee, who don't experience that joy every morning with my first sip. All right, with milk, black, no sugar. A lot of black coffees here. All right, half and half in sugar, black, all caps. Shauna, I feel you. Okay, so we have a lot of good coffee drinkers here. I'm glad. Okay, a couple Splendas, triple latte. Michael, my goodness. All right, so let me show you about how tariffs might impact your lovely cup of coffee. So on occasion, if I like to sort of unwind on the weekend, I like to pick a new coffee shop that's somewhere in Austin and go check it out. So that cup of coffee, the original cost of it, let's call it $4.29. And John actually did a good bit of research on this. So there is some good methodology behind these numbers. We didn't just make them up. Interestingly, the cost of the coffee beans that goes into a cost of a cup of coffee is teeny tiny. And so if you think about a 10% tariff on Colombia, this is part of like the standard tariff on all imports, that's only going to raise the cost of your cup of coffee by a single penny. Then think about the machine. So let's say, whoever had the triple latte, right? You need an espresso machine to be able to do that. You don't buy that all the time, but every couple of years you need to upgrade. It's pretty expensive. So we kind of looked at what that would cost, what the tariff would be, and then imagine that you do that every year or so. The incremental cost to that single cup of coffee is also only going to be about a penny. Interestingly, assuming that you drink that cup of coffee in a disposable cup, that is subject to 125% tariff on China. Almost all of our paper cups are made in China, so there's not a lot of substitution today that's available. That's actually going to increase the cost of your cup of coffee by 11 cents. That's a pretty big increase. Now, am I still going to pay $4.43 for my tariff cup of coffee? You betcha, because I love my coffee and I'm not going to compromise on it. But that I will have to eat that. And, I was talking with somebody else and I'm like, well, why don't you just bring your own mug? And of course, yes, maybe I'll say, I don't need the cup. I have my reusable mug, and please use this. That's a good example of substitution, right? Consumers who are getting creative about how to get around some of these. And so those are the things that happen over time. And I'm not going to ask anybody to give up their coffee, but it might be helpful to give up your paper cup, right? And you can still get the most of your pleasure out of using that reusable one. All right, so just a little real life example. So now the question is like, what do you actually do as an investor? And the first thing I would say to this is we think about stuff like this all the time. And I always say the time to build a battle plan is before you're in battle. And one of the core tenets of what we do here at Kessler Investment Management is be disciplined. And so we think about these playbooks all the time. And I often think about like my husband who served in the Navy, and he was in submarines. And let me tell you, it takes a special person to be able to live underwater for weeks at a time. But I love his stories about life on the submarine. And, one would be that he would get waken up in the middle of when he was supposed to be sleeping and they would have to do drills. One of the drills they would have to do is pretending that the oxygen had been cut off in the sub. And they all have masks that they need to put on in the dark because the electricity has also gone out. So they have to feel their way around, get their masks on, and then they have to daisy chain like 10 masks from one to another. So you have to find another guy in front of you and daisy chain it. And you have to do it in like a minute or two because that's all the oxygen that you have left. They would do this all the time, and he would get woken up in the middle of the night to do this. So that, by the fifth time you do it, you're like, here we are, and you can get it done really quickly. You do that because when the crisis actually hits, you're ready and you have that muscle memory. So this is what I talk about when we think about building diversified, well-structured, resilient portfolios. We're not going to rely on just the Mag 7 to be able to deliver that return over time. We're going to look to get exposure to a wide variety of asset classes, different ones that are going to benefit from different types of environments. And so we talked a little bit about owning non-US stocks, even some emerging market equities. Emerging markets are often countries that carry more inherent risk, but they react to different types of economic cycles. And so there are going to be some emerging markets that actually benefit from these tariffs. Think about like Cambodia, Vietnam, India. There's a ton of manufacturing right now that's being moved from China to these other countries, and they'll be able to benefit from it. Bonds are another great example. I showed you earlier how like a diversified collection of bonds has actually been positive so far this year. So these are the things that we think about all the time and we try to be ready for. Now, once things start to evolve, then of course we're going to take that information in and make changes. But in general, we're not going to be running for the hills just because some negative headlines come out. All right, so let me remind you also that there is no reward without risk. The only portfolio I've ever seen that goes up every single day is Bernie Madoff's, and we all know how that ended up. So every year back to 1980, at some point during the year, the market has been down, and most of those years the market has been up. I don't know what will happen this year. I have a crystal ball. It's here on my desk, but it doesn't work. So all we do is be prepared for whatever the scenario is. But in general, over time, the market goes up, but in the meantime, you have to live through some of that volatility. So I want to take you through, and I want to be mindful of time as well. I want to take you through a couple of scenarios. This one in particular, I think everybody on the call here is going to be able to remember what this is like. So back in 2020, hard to believe this is only 5 years ago. But you can see this is the S&P 500 at the beginning of 2020. And as the market started to absorb this idea that COVID was coming to the US, that it was going to impact Americans, it was going to impact American businesses, it was going to send us home, it was going to send our kids home, right? This extraordinarily quick decline in the S&P 500. I mean, it was mind-blowing. And I remember mid-March, we were supposed to head out on spring break with my family, got called off literally the night before. School was called off. Everybody was told to shelter in place. And John, if you will, just scroll forward once. So this is a picture my husband took of me in my makeshift office. You can see my very healthy lunch of shredded cheese. This is what it had come to. And you see, so that's like my usual screen of all different market indicators. That chart in the top middle was number of COVID cases and number of COVID deaths. And you can see it starting to go what we call parabolic. So it was going almost straight up. I think at that point, the number of COVID deaths was about 1,000. So you can see there, it's about the third week in March. Now think about that. This is the very, very beginning of COVID. In the US, millions of people would go on to die. It would be months before we had a vaccine. It would even be months before we had a reliable test to know if we had had COVID. We didn't know how it was transmitted. We didn't know how long people had it. There was so much we didn't know. But guess what? It was a week later that the market bottomed. The market didn't bottom because we had full certainty. And it didn't even bottom because things were getting better. Things would go on to get much, much worse. But the level of uncertainty decreased. We started to learn a little bit more about the disease. The government started to step in with stimulus, and there were more things that we could kind of be able to rely on to form a base. And in fact, the market had a very, very quick rally after that. But like I share this because I can remember vividly, and I remember my daughter, who was I think 6 years old at the time, sitting next to me when this photo was taken, playing cards by herself because she was so bored. This was a horrible feeling, and still when the market bottomed. Let me share one other scenario that you all might not remember personally, but I remember hearing talk of. So the 1987 market crash. My grandfather, at the time, he was a retired accountant, very numerate, very smart, thoughtful. He had dabbled a little bit in stocks. And after that market crash in 1987, he was watching the evening news. The S&P 500 fell 22% in one single day. It was absolute pandemonium on the floor of the stock exchange. He was a nervous wreck. He got the Wall Street Journal the next morning. He's an accountant, of course. So he tallied up all of the losses that he had experienced that day, called his broker and said, "Get me out, sell every last share of stocks that I own." He never bought another stock. And in fact, he lived another 30 years and missed out on one of the greatest bull markets that we've ever seen. Right? There's my grandpa. I learned a lot from him, but investing is not one of them. This guy could have enjoyed this incredible bull market, but he just couldn't take it. And it was too much for him. And he felt better, right? He felt better when he sold those stocks, but think about what he missed out on. So these are things that I want you to keep in mind as we go through this level of uncertainty. I'm not going to tell you everything's going to be great. I can't even tell you that tomorrow things are going to turn around, but I know that the market will find a bottom as soon as the uncertainty starts to become a little bit less. All right, so let's take a quick look at something else to remember. John did this work looking back at the 10 worst days in the S&P 500 going back to 1950. What you see there is that in almost every single one, the market was up, and fairly significantly 1 year later. Now, if you'll notice, some of these are pretty close together, meaning that in September 29, 2008, that wasn't the bottom in the market. The market continued to go down. But in most of those cases, the market was up significantly a year later. So remember that this market volatility can create opportunity for you. Last slide, and then I'm going to turn to some questions of yours. So this is one of my favorites. It's showing assets after inflation. So we're taking out inflation going back over 200 years. So back to 1800. What you see there is stocks is far and away the best, most reliable way to grow your wealth over time. Bonds do a pretty good job along the way too. You don't have the same level of return, but you have a much more even ride along the way. I mentioned gold earlier on. And again, I don't mean to pick on gold, but I go back to this. And we're big fans of looking at the empirical evidence and getting a sense of what the historical picture tells us. If you look at gold, you have these short spurts of outperformance, but over this 200+ year period, it actually does not have a great track record of growing wealth over time. So something to keep in mind as you're sort of looking for how to invest your assets. Okay, so thank you for hanging in with me. Let me pull up, I have a list of your questions because I know some of you had sent some along earlier, but please, if you have any additional access, and any additional questions, please go to that Q&A button and you can kind of type them in. And I'm going to paraphrase some because we have some that are sort of like similar to each other. So let's think about what are the implications for US investors if Trump replaces Chairman Powell? So for those of you, again, who have been lucky enough to not be glued to CNBC like we often are, there's been talk over the last like week or so that President Trump is going to look to oust Fed Chair Jerome Powell. Normally, there's this very careful separation of power between the executive or any other like political body of government and the Federal Reserve. The Federal Reserve is tasked with monetary policy, keeping the economy on a steady footing, and as such, it's very important that that body remains separate from the sort of like day-to-day pressure of politics. Now, that doesn't stop politicians from trying to influence the Fed. In fact, I happened to be on Capitol Hill last fall, and on that very day, Elizabeth Warren sent a letter to Jerome Powell pleading with him to cut interest rates. So again, not to pick on anybody, but just to show that this pressure, this political pressure, comes from both sides of the aisle. Now, that said, President Trump has been much more vocal about the possibility of pushing Powell out. If the Federal Reserve were seen as influenced by politics, in my view, it would greatly diminish the central bank's power to direct monetary policy. And we've seen this happen in plenty of other countries. This is not like an isolated issue. But once central banks start to lose that independence, it becomes much, much harder for them to do their job. So I think this is something that's going to be very important to maintain. And so far, what we've seen is that Trump's advisors are sort of keeping him a little bit more limited and less focus on sort of ousting Powell. So I think that will be really important. What are the risks of stagflation, and how does that risk align with the risk of the national debt? So I mentioned earlier, consumers look like they're in pretty good shape without too much debt. Companies look like they're in pretty good shape. US government, not so much. So what we've seen is that over the last like 40 years, even as the level of federal debt has gone up, the cost of servicing that debt, think of like the monthly payment on your mortgage, right? The cost of that has gone down. Why? Because interest rates have gone down. However, over the last couple of years, interest rates have gone up, which means that our debt is now here, and the cost of servicing that debt is very quickly going to start to rise unless interest rates come back down again. So what that means is that this is a big challenge. And I call like increasing debt and spending an American problem. This is not a party problem. Every single president, beginning with beginning with Truman, has increased the level of federal borrowing. So this is a really intractable problem. It is a challenge for both sides. And so it is going to be a big deal for the government to start to chip away at. So I think this is a risk. And I think the government is going to have to really sort of take some hard steps to be able to address that. Okay, how can we prevent any further free fall of our investments as the economy moves to recession and higher interest rates? So we as investors cannot, right? So remember, like focus on what you can control. In the market, we can't control. The economy, we can't control. Policymakers can influence the economy, but we can't control it. So we then just react to, we're ready, we have our playbook, and we're disciplined about how we position ourselves in different market environments. But if you're asking from a policy perspective, what can the government do to prevent a recession? And I think this is really important. Remember that having certainty about what the tariff rate is and what the policy is much more important than what the policy actually is. Knowing is more important than the what. So if you told me that tariffs are going to be 25% and it is going to be like that for the next 10, 15 years, then companies can start to plan and they can make decisions and they can react. But if we have the on off all the time, that is actually more damaging than having that level of certainty. So we're coming up on time. There are more questions that we didn't get to, but hopefully we got to most of them. If there is something that you're really curious about that we didn't get to talk about today, as you can tell, I like talking about this stuff. So happy to follow up. Please just ping myself or your financial advisor. And until next time we're here, please let us know if we can help with anything. Hang in there, focus on the long term. And as I always like to say, invest wisely and live richly. Take care.